We will start with the new aspect. So you are understood the definitions, recognition of the financial assets, recognition of the financial liability. So the next thing we will move on to the compound financial instrument. Actually, it's a very simple. No? See, you know financial asset, okay, you know financial liability. What is the compound instrument? It is a financial instrument where there is a two components mixed together, which is one leg is a financial liability, another is the equity. That's why it's called a compound. Compound means mixture. Now we are going to talk about the split accounting. So when a financial instrument has got the characteristics of liability and equity, that means it will pass fixed for fixed test. At the same time, there is a liability also for you. Then you call it compound financial instrument. So how do you account it? So you will go with the transaction price. But is that transaction price fair value? No. There are two components splitting there. You deduct the fair value of the liability component, equity becomes the balancing figure. For example, loan given to the staff. One element was a liability or an asset portion. The other was a balancing figure. No? Discount on the employee stock. It's like that only. You have to calculate it like this. So can you give me an example of a compound instrument? Where you have got a liability also, equity also. Sorry? Convertible debentures. Okay. Now, if you talk about a convertible debenture, let me open one blank PDF to you. See what happens in a convertible debenture. See, if you issue a convertible debenture, what do you mean by this? That means you have got say 100 convertible bonds are there. You have issued and there is an option. Question comes, is it compulsorily convertible or optionally convertible? You have to see, no? Because both will change you the meaning of the definition. So let us assume that it is an optionally convertible debenture. Now, if it is an optionally convertible debenture, now second question comes at whose option it will be converted. It can be at the holder's option or at the option of the issuer. See now, okay, so first we will write we'll put a chart like this. You have got a convertible debenture. It can be compulsorily convertible, it can be optionally convertible. If it is compulsorily convertible, that means principal is always an equity, provided it will pass fixed for fixed test. That means I will say the day I issue, for every one bond, 10 equity shares I am going to issue. So what happens? I have got 10 lakh rupees. And I know 1 year or 5 years down the line, this 10 lakh rupees will get converted into say fixed number of equity shares. So it will pass as fixed for fixed test. Second question comes, what about the interest, sir, every year? Can you avoid it? Is that interest is also convertible, cumulative and convertible? Like one of the employee cost we see, that person didn't pay in interest only. That 1,20,000 interest, no, he paid in subsequent installment. What if like that I will convert that interest also as a capital? Then entire instrument is an equity instrument. Otherwise, in compulsory convertible, principal portion is equity, interest portion is financial liability. Now, when it comes to optionally convertible, you will ask me one more question, sir. At whose option? At the issuer's option. When it is my option, when I will convert? Whenever it is beneficial to me. If I don't have cash, I will convert it. If I have got cash, I will not convert it. Do I have got a contractual obligation to pay cash? No, you cannot go to the court and say, pay me cash. You cannot enforce it. The day you got cash, I will convert into equity shares. That's why for issuers options also, principal portion will be accounted as a equity. Interest, since I cannot avoid it, I will account it as a financial liability. But when I give an option to the holder, you convert or don't convert it. On the principal portion, I don't have any, see, interest though, interest part of financial liability only. What about the principal? It is a financial liability to me because If it is favorable to him, he will definitely convert it. In AFM, you are going to come across this calculation. Oh, should I convert? Which is convertible? If I convert, considering the bond value, what is the benefit to me? These are all financial decisions. Now, followed no. If it is a holder, then it is a principal will be financial. But you have to understand. If it is non-convertible, I will give you a 10% interest to you. If I give convertible option, and that option I give it to you, I am the issuer, you are the holder. Will I give you 10%? Will I give you more than 10% or less than 10%? Yes, no. Its point is simple. If you want option, pay me, I will pay you less interest. Don't want option, pay me 10%, finish. It's like, you want guarantee, 8%. Don't want guarantee, 11%. So the difference between this and this is what? It's the cost actually. Or it's the benefits I am saving, which is nothing called the premium what I am paying for the option. And this option, this premium is fixed today only. I know the difference between what I would have paid you without conversion versus what I actually paid you with the conversion option is the benefit you are losing, benefit I am getting, like 30,000 in the previous guarantee example. It's the benefit involved. Now this is fixed inflow to me. Is it going to change next entire 5 years of my contract? No. In next 5 years of contract, in the previous bank guarantee example, your always benefit was 30,000 per year. Did it change? Never. Now when you are going to convert 1 to 10, is it going to change? Never. Once the contract is signed, how many shares you are going to issue? It is fixed. How much benefit you have got to get? That is also fixed. So this option is treated as an equity. Does it fall in the definition of an equity? Yes. If the instrument will be settled in the own entity's equity shares, and if it is a derivative contract, there are 4 definitions. No, what is the financial liability? What is an equity? Oh, there is no contractual right to issue, pay cash, no unfavorable situation, and if it is a non-derivative contract, passes fixed for fixed test. If it is a derivative contract, so now if you see this option has passed that test, because this option received a fixed premium, and its option is going to convert 1 into 10 fixed shares. That's why this option is treated as an equity. So I need to split the transaction price into financial liability and equity. This is called split account. We'll do the problem and understand it better. Now I'll give you a case like this. Convertible instruments are issued at the option to convert the bond into equity only varies with the time. That means I have issued you 10 lakh rupees, bonds are at par, and you can convert into ordinary shares. Who? The holder. If you convert next year, I'll give you 100. If you convert second year, I'll get 120. If you convert third year, I'll give you 130. Now tell me, does it pass fixed for fixed test? Because today the premium amount is fixed, but the number of shares which you are going to convert, is it fixed? Variable, no baba. Because the option holder can convert first year or second year or third year. Like I have issued a bond to you, debentures to you, and you have given money to me, and I have told you, look, you have paid me 10 lakh, no, and you have purchased 1,000 bonds, right? This 1,000 for every single bond, I will give you 100 shares if you convert at the end of the first year. And who has got the right conversion right? You have got it. You are the holder, right? You are the debenture holder. If you convert second year, I will give you 120, 130. Now, the market rate of interest is 10% without conversion. But since you are opting for this option, no, I will give you debentures at 8%. That means you will accept less rate of interest from me in return for an option to convert. So the benefit what I am going to get is 2%. Is it fixed? From my perspective, yes. But how many number of shares I am going to issue to you against this 2% benefit? Is it fixed or variable? variable. Then you say, sir, this fails my fixed for fixed test. Then there is one. ICA means the standard tells you one thing. Look, if this variability is coming just because of the time, not any other reason, not because of the market price, then you can treat it as an equity. Or financial liability at your option. You treat it yourself. You can tell, sir, it is a liability for me or it is an equity for me. But if this variability is coming other than time, it's always financial liability. Yes. What is your doubt? Now, see, my point is when it is variable, like today you have paid me 10 lakhs. And if I say 10 lakh worth of shares I am going to give you, depending upon market price, then every year the market price, depending upon, say, if the market price is 100 rupees, you end up issuing 10,000. If market price is 10,000 rupees, you issue only 100 shares. So there is a variability here. This variability is not because of the time. This variability is because of the market rate. That's why you treat this entire instrument as a financial liability. Because you say that it has failed fixed for fixed test, and that failure is not because of the time. But here on day one only, you have given 3 variabilities. But on day one only you know, either 100, 120 or 130. It is not that on day one you don't know. That's why even though it looks like failure of a fixed for fixed rate, the standard has given an option to you to treat either as a liability, telling no sir, it has failed. No problem, treat it like a liability, or treat like an equity. There is no question in 109 on this, but in Ind AS 33, there is one application of this. So when I talk about Ind AS 33, I will again bring it back to you, this particular point, so that you don't tell me, sir, in 109 you didn't tell me only. That's why I'm just telling you. Now, what are the examination scenario, question scenarios which you can find in the ICA questions with regard to this particular compound instrument? They may say compulsorily convertible into equity. It is called CCPS, compulsory convertible preference shares. 100% of the present value of 100% is only the financial liability. Principal is equity. They say 50% is compulsorily convertible, 50% is payable. In that case, present value of 100% interest plus 50% principal is only your financial liability. Balance is equity. Equity is balancing figure. Option to convert comes. If it is at the holder's option, all principal and interest is liability. Convert else redeem, they will tell you. They will not tell you whose option it is. Then you have to assume that it is at the holder's option. Same story. They may say redeem else convert. So say both are same, no? No, both are same. Then why ICS should give same? In one question, one language they will use. Then also same story. But if it is the issuer's option, they have to decide based on the circumstance. Okay, but such questions are not there. Next, what if they convert? On conversion, that means on actually conversion, since you have recognized one liability, did you pay that? Because you have recognized the present value of a future liability, which is at a fair value. Did you pay that liability? You didn't pay. So, de-recognize the liability by transferring it to the equity, because there is one cumulative balance of the liability. You pass one entry, liability account debit to equity. Original amount of the equity, that means which you did split accounting. See, and understand, student, you may not have grasped this, what I am trying to tell you. But I should tell you this so that you understand when I'll same theory I'll discuss there. See, initially, when the transaction happened, you split into 2 components. And you must have passed one entry. What is that? Bank account debit to financial liability to equity. This is the ulta entry of your financial asset there. In financial asset, loan account debit, discount account debit to bank. So that discount was like an equity, balancing figure. Now, the day this gets converted, You will, if it was not converted, if it's paid, then you pass financial liability account debit to bank. Because this you will find out the fair value, no present value. And you unwind it using amortization schedule. You're getting connected to what my language? You're getting connected to my language. What I'm trying to tell? Look, you have got a financial liability and talk to your friends like this only. They should say, what language you're speaking? FR language. See, you recognize the financial liability at its fair value, which is nothing but the present value, which is always less, say less than 10 lakh rupees. And you unwind it. And one day it becomes 10 lakhs. Then you debit that 10 lakhs, credit bank. If the option holder asks for payment, if the option holder say, convert me, there is already a cumulative balance of 10 lakhs. Debit that, transfer to equity share capital. Then you'll ask me, sir, what is this balance? It is always lying, no? If you remember my day one class, then I showed you one statement of equity, other equity. So many columns were there. Till the time it gets converted from this amount will be always shown in the first step called the equity portion of compound financial instrument. And the day it gets converted from here, it will move to other leg, say retained earnings or whatever it is. That's why in FR language they say that original equity component will remain as equity. That means there is no recycling. It will be transferred from one item of OCI, one item of other equity into other. You understood, no? What I am trying to tell here. So your other equity has got so many head like this columns. Infosys I showed you. I say opening balance. The first heading was compound financial instrument account, that differential portion. Then you had got retained earnings. Then you have got OCI here. So what they said, the day you transfer, this balance will get transferred to the other head. And there is no gain or loss on the conversion. In case the settlement at the conversion, liability will be paid off and original equipment will remain in equity only. Then instead of financial liability account debit to equity share capital, you say financial liability account debit to bank, and this equity will be transferred to the equity. What if early settlement is going to happen? Difference that originally you on the day one you found out one difference, no? And this difference is nothing but the option premium benefit what I got. That you transfer from one head to another head. Probably you will transfer to the retained earnings. So that's the benefit you got, no? But you will not take to P&L account because it's not subject to recycling. Equity components are not recycled. That's why equity FVOCI is not taken to P&L account. From one head to another balance sheet, retained earnings they transfer. Perfect? Perfect, no? Now, what if early settlement is going to happen? Simple. Have you not done in financial assets early settlement? What did you do? When the early settlement happened, you split that into again two components. One is discount component, one is the financial asset component. Same story. If the early redemption is going to happen, it should be again allocated between equity and liability. How? This is the amount of redemption which you are paying. And what is the liability component? Present value of the future contract. That's the fair value on that day. And differential amount is the equity. Now, any gain or loss on the liability settlement will be transferred to the P&L account. Any gain or loss on the equity will remain in equity only. With this, no early conversion, on early conversion, the financial liability will be transferred to the equity. No gain on losses on early conversion will be. That means early settlement, redemption, all this headache is going to happen. But if early conversion is going to happen, that means redemption means I have to pay cash. All this calculation, P&L will come. But if early redemption conversion is going to happen, simply whatever cumulative balance is there, it will get transferred to the equity. That's it. With this, we are successfully completed with the compound financial instrument. Now, who on earth have you understood at least? Okay, I'm not expecting full. Did you see one very simple things here? Replicas happening. And every questions are coming here only in this group only. Plug and play. Here one instrument, here there is one concept. Now, to understand these concepts better, we will move on to the Q&As. three things. First, we'll do split accounting. We'll solve problems on conversion. We'll solve problems on early settlement. Conversion, when you convert at the end of the year, whether you convert mid of the year, doesn't make any difference. What is the entry? Simple. Liability balance account debit to equity. Finish. That's it. Delimited. Issued preference shares. Be careful. To G Limited for a consideration of 10 lakhs. The holder of has an option. Who is holder here? G has got an option to convert preference shares into fixed number of equity shares at any time in next 3 years. Okay, who is holding the option? The holder. Now, if the option is not exercised, the preference shares are redeemed at the end of the 3 years. It is convert or redeem, but the holder is holding the option. Do I got an obligation to pay cash? Can I avoid it? No. That means there is one leg of financial liability. Now, because of this option is given, what is my interest rate on preference shares here? Preference shares carry a coupon of RBI plus 1% and is payable at the end of every year. Now, what is my RBI rate now? The prevailing market rate of similar preference shares without conversion would be RBI plus 4%. Simply to confuse you, okay? And what is RBI rate? 9%. That means my coupon rate, what I pay you is 10%. If I would not have given you this option, the coupon rate would have been 13%. Now, who is losing here? G is losing. Why? Mad or what? No, it is because of the option. Can I say something like this? It is the premium paid by G for getting this, buying this option, because options has got a value, no? In derivative chapter, you learn that option valuation, your Black and Scholes model, binomial model. Why on earth those things are there? Because options has got a value. Somebody is not fool enough to give such options to you. It's like you go and tell a caterer, oh, my birthday function is there in the month of December. On that day, if morning I tell you supply me food, others morning I'll come and call and tell you don't supply the food. Will anybody accept such order to you? No. They may accept. They will give me one refund, give me one amount. Based on that, I'll forfeit otherwise. Followed, no? It's an option premium. So you have got a fixed consideration, and right now I know how much benefit I'm going to get. Delimited. Yes, 3% is the benefit I'm going to get for the next 3 years. And in return for this, what option I have given to you? To convert into variable or fixed. Am I converting your preference shares into equity share, fixed or variable? Fixed. So this option contract pass fixed for fixed terms? Yes. So there are two components. One is my financial liability component, which is meant for redemption, and redemption is not in my control. You opt, I have to pay. So it's a financial liability. And the balancing figure, because it's an off-market instrument now for me. Because of this option, 10 lakh is not its fair value. And 13% is the market expectation without this option. So I have to discount and find out what is my option value, and I have to treat it like an equity, because I will see what is equity. Residual. Like today you got some money, you need not repay it forever. What do you call? It's equity, right? Where it will find? It will find its place in the retained earnings. Either you spend it, like you earned a salary. What it is? Equity, no? You need not pay. You need not give something in return. But if you got advance salary, no, it is your liability. Unless you offer your service. The moment you offer your service, it will go and sit in your retained earnings. It's the balance sheet P&L story journey. What did they ask me? Calculate the value of liability and equity. Simple. Should I write it in theory? No. Calculate. No. Straight away go into the calculation. Okay, right. Calculation of debt and equity. What is my transaction price? Huh? If they would not have mentioned the fixed, then they should have told, no, what is the, how the conversion is going to happen. That logic they would have told. Chalo, worst case scenario, they would have converted into variable shares. Then entire financial instrument will be treated as a financial liability. Or I can call it like a hybrid instrument. In a hybrid instrument, one leg is a financial liability, another leg is a derivative. Because option is a derivative, no? Then it is called as embedded derivative. After this, we are going to discuss that. Now question comes, should I separate this embedded derivative or should I make it part of single contract? There are some tests, embedded derivative test, economic characteristics test and all those things. Then again, should we split it or should we consider in one? We have to decide, followed, no? See, our job is to try to bring out the truth here. You enter whatever type of transaction on earth you enter. Chalo, go. Let us compete. I will bring out. You can't hide it. Accounting standard helpless. Transaction price is what? 10 lakhs. What is my fair value of liability, financial liability? Is there a principal portion? Yes. How much? 10 lakhs. When I'm supposed to pay this? Worst case scenario, at the end of third year. If you don't opt, whatever may be the case, worst case by third year, I have to pay this into what is my present value factor at 13% for 3 years? 0.69305. Is there any other in payments? Only one stream of payment here. Is it a, what type of bond it is? Conventional, zero coupon bond, perpetual bond, what it is? Conventional, because if you don't opt, I have to pay the premium, return the principal, and every year on this 10 lakh, how much interest I need to pay? 10%. So 1 lakh into, for every next 3 years, 2.36115 present value annuity factor. If it was a financial liability, I would have recorded 9,29,165. Then you will ask me, what is the difference? L1, L2 inputs are not going to come into picture here because L1, L2 inputs are applicable for a financial asset. Here you say that the balancing amount is the equity component. That means this much premium you received right now in the form of that 3% benefit for giving an option to someone to convert their bonds into my equity shares. This option may be exercised, may not be exercised. But the fair value of the option today is 70,385, which I am never ever going to return this back to them, whether they exercise or whether they don't exercise. So this is my equity. But I will not take to P&L account. Why? I will keep it in the balance sheet. And the day, whether exercised or not exercised or settled, from there, I will take it to the, till that time I show to the world, oh, I have issued one compound instrument. That's why I will present it separately in one separate line. Then I will move to the retained earnings. Otherwise, straight away, if I move it in the retained earnings, no, nobody will have any clue at all that I have issued this type of instrument. Perfect? Yes. So we'll move on to the next question. On 1st of July, D Limited issued preference shares to G Limited for consideration of, oh, I think some same story. Holder has an option to convert equity 3 years. If option is not exercised, preference shares are redeemed at the end of third year. Coupon 6%, okay, there RBI and base rate and all. Yes, coupon rate is 6%. Prevailing rate is 9%. So 3% is my difference. Examine the nature of the financial instrument and calculate the value of the equity and liability. If this question comes to you in the examination, what you will do? How much mark allocation I have told you? 8 marks. What you would have written for 8 marks? What theory you write? Will you say this is off market? Need not be, no. Okay, understand. General certain set of theories will write at certain places only. Now, when you look at this, what is the nature of the financial instrument they are asking? What is the nature of the financial instrument? On what basis you say? Yeah, very good. That's what I'm looking. Huh? Some confusion. Oh, yeah, your approach is correct, but you have to present it in a very nice manner, no? Okay, fixed for fixed is past. Then, and you have to pay the interest. See, there are also not many components coming into picture. Examine means what? What is the meaning of examine? Compare with the benchmark or look for components. See, you go to one jewelry guy. You say, sir, please check whether this gold is this ring is real, because somebody wants to sell you. You go to that jeweler and say, is this gold or not gold? You tell me. What he will do? He will examine. How? How does he examine it? How? Test it. How? Tell me, what all the testing here? First, he will look it very closely. Then, he will take one small piece out of it on a sample basis. Or will he melt everything? He will hit it with his hammer. Correct, no? So, that piece must be crying. It will hit with the hammer. Then what he will do? He will pour acid to that thing. And what he will try to figure out, in that small sample taken, how much impurities are there? That's what you have come for, no? How much is this carat? Now, for this, no, you have to look into the components in detail. Like somebody is asking, okay, is this person CA? They will go to a goldsmith. Who is goldsmith? Our goldsmith? ICA. ICA will take one small piece of you. How? In the form of one examination on a sample basis, no? They have to do it on sample basis only. They will hit you with a hammer. One complicated question on embedded derivative. Another complicated question in audit you never expected only. They will give you like that. FR you are thinking it will come easy. Somewhere they gave one fitting there. Third question paper was easy. Like they will test you from left and right. All this analysis is going to happen. How? Component wise. You are not tested in one paper and say certified as a chartered accountant. You are tested in every single, and then they will verify what you are. See, examination means, there is a meaning of examination. Examination means look into the pieces on a selective basis, look into it very closely, what it is. That is examination. So it is a mixture now, club the instrument. So you have to break it into pieces. Okay, there is one option is there is one principle is there is one interest is there. What is the nature of the instrument? Can I award that interest? No, it's a financial liability. What is the nature of this principle? Can I award this principle? No, it's a financial liability. Then what is this option sitting? Is it passing fixed for fixed test? Yes. Then you say it is a compound instrument. Then you say this is so and so gold with so and so carat. Then people trust. That's called hallmark certificate, correct, no? And that is your result day. Result is not going to change you, no? I think I told you earlier also. This result is going to change you the day before the result, one day before the result? No. How it's going to change, Baba? Yesterday you are the one person and you are able to solve one problem of society. Next day morning also you are the same person. You will be solving the problem in the same way. But the previous day, nobody was calling you. You are unknown in the society. Next day, left and right, all of your relatives are calling you. Congrats, congrats. Why? Because they could see one certification, hallmark certificate, which is a matter of trust, which doesn't change you, what you are, but it will change the perception of the society. It is a breakthrough for all your efforts, what you have done from your first year piece. You got my point, no? It is like, I'm just deviating somewhere in between, thinking hopefully you are trying to connect with my emotions. Huh? This is what I realized over a period, that what is success, what you need for it, okay, what is examination, because we give too much importance to examination. Why? Because we have been trained like that from our childhood. Look into the marks. But how that marks are going to come? Why marks are needed? What is the meaning of that marks? That's very important. This is what I realized after I resigned. Anyhow, now let us examine this and present this. Okay, first write the solution. Always the word examine comes, look for components, right? The instrument has two components. One, contractual obligation, correct? To pay interest and principal. What it is? Financial liability. We got one component. So when that examiner was examining this instrument, he found, oh, there is one component of interest and principal. He will club it together because both are contractual obligations. And it's a financial liability. Second, there is one conversion option. Okay, don't write here financial liability. In examining, first you find out what is there. Then you come with your opinion, what exactly it is. So you say that there are two components. There's one option is also there. Principal and interest payment is there. The first component is financial liability. Why? Because there is contractual obligation, or I can say you cannot avoid it. You cannot avoid it. Or you can say contractual obligation. Doesn't matter, student. You will get marks. But you are communicating someone. Followed, no? So you said that there are two contractual obligations and option. First component is a liability because it is unconditional. You cannot avoid it. The second component is equity. Why? As it has preference shares converted into fixed shares, and on day one only you know that. In bracket you could have read past fixed for fixed test. Therefore, this is a compound financial instrument. Now you give your conclusion. They may allot 2 to 4 marks for this. So you have to write a theory here. Whenever they come with the word called examine. Examine is a word for a theory. What is the second question? Calculate, right? Calculation of debt equity component, transaction price, 10 lakhs. Since in your examination you told the interest and the principal is your obligation, less fair value of financial liability is how much? 10 lakhs into 0.772183. It's the same number actually, like previous question. 1 lakh into, not 1 lakh, 60,000. 10 lakh into 6%, because previously it was 10%, into 2.5313. So you are going to get 9,24,061, and the equity component will be 75,939. Okay, done. Are you very clear, students? Whatever you did, any doubts? No doubts? Yes, Dhanush, you have doubts? Okay. Students, please pause the video. This is not an examination question. Since you said you have understood everything, perfect. Please solve this problem. Please pause the video and solve the problem. Okay, students. So you have seen, no? Questions can come like this unexpectedly. That's what I'm asking. Before I proceed, are you clear in every aspect? Have you understood everything? Okay. Now, in this case, P company takes a loan from Q. That means you have issued, say, debenture. You can call it loan. No. Simply they said holder, issuer. No problem. You have issued a loan instrument for 12 lakh. The loan is perpetual. What do you mean by this? Principal will never come back to you. Means you need not pay that. And entitles the holder at 8% fixed. The rate of interest commensurate with the credit risk profile of the issuer is 12% per annum. What is this 12% per annum? That means it's an off market. Generally, for you, Q should have charged 12%, but Q is charging 8% for this perpetual instrument. Followed, no? Now examine the nature of the financial instrument. So you have to write a theory now, that you have to look into the components, calculate the value of the liability. Now, how many components are there? In the previous question, there were 3 components. Interest was there, principal was there, option was there. Principal and interest nature was same. That's why you clubbed into one and say it's a financial liability. And the option you discussed. But here, how many components are there? Only 2 components. What is that? One principal, another is interest. Now, what is your interest? Do you have got a contractual obligation to pay cash? Can you avoid it? No. That's why it's a financial liability. What about the principal? You don't have any financial obligation to repay. That means today you got a cash. You should not repay. What it is? Equity, no? That means entire principal is your equity. Somebody pays you cash. If you need not repay them back, that's equity. Simple as that. Because the definition of equity is a balancing figure, residual. Now, question comes, what is the value of the equity now? Is it 10, 12 lakhs? No. Transaction price minus the value of debt is the balancing figure, is the value of the equity, because it's the compound instrument now. Nice question. So, what you need to do? First, you will say the instrument has got 2 components, mandatory interest and the perpetual nature of the principal. What about the mandatory interest? You say the mandatory interest is a financial liability because you don't have any unconditional right to avoid the payment. Okay. But what about the perpetual principal? Can I proceed further, students? Yeah, you can, whatever. See, my objective is you to make mistakes, learn, figure out what is that, open up your mind. Okay, you can practice again at home. Because after understanding this, sir, Ishtaya, this is so simple. Why it didn't strike to me? You are going to find now. Now, what is my other component? You say that since, look, it's an equity. Why it's equity? Because today you received something which you not required to repay it anyone. It's like a donation to you. It's like your pocket money your relatives give. It's equity, no? It's an income. Now, hence it is a compound instrument. This is the examination part. Now, you have to find out the present, what is that called? Split accounting. So, what is the transaction price? 12 lakhs. What is the fair value of the debt? For this, we have to see what type of instrument it is. Perpetual. How to find out? Coupon payment divided by the YTM. This is the equation. So, coupon payment is how much? You get 8% on 12 lakh perpetually. Divide this value by the expectation of 0.12, you get 8 lakh rupees. So, fair value of the loan is 8 lakh rupees. What if the expectation is also 8%? Then fair value of the loan is 12 lakh. That means there is no equity component. What you are paid today is the present value of all the future cash flows. That means entire value is your financial liability only. So, your equity component will be 4 lakh. Are you clear? And that is the benefit you got. Because for your type of profile, he should have charged 12%. But since he's charging 8%, 4 lakh is the benefit what you have got right now. And that is equity. Now, why on earth he gave you 8%? When somebody is charging 12%, that is a debt. For me, it is equity. Now, for him, L1, L2 inputs are going to come because for him, it's a financial asset. No. L1, L2 inputs are going to come. He will also do the same thing now. Present value of the future cash flows. For him, also present value of future cash flows comes 8 lakh. He will pass an entry, financial asset account debit, discount or loss account debit, L1 input, P&L to bank. Perfect. Entries are clear? Yes, we'll move on to the next question. K Limited issued. You can leave some space, okay, if you are not done. Students, you can pause the video and redo it if you want. K Limited issued 5 lakh 6% convertible debenture. Be careful what they tell. Sometimes they say compulsory convertible, sometimes they say perpetual, sometimes they say non-convertible. God knows what all things they will give. Face value 10 rupees, 1st April. The debentures are due redemption for 2015. At a premium of 10%, convertible into shares 50%, and balance to be settled in cash. Oh, this is one scenario where 50% is compulsory conversion and 50% is compulsory payment. There is no option sitting here. The interest on the equivalent debenture without conversion was 10%. How much you are paying? 6% with that 50% what you pay, no, 2,50,000 with the 10% premium. Redemption, examples I started, no? You will pay with the premium. You are required to separate the debt equity component at the time of issue. What do you need to do? Calculate. You have to calculate how much is your debt, how much is your equity, and show the accounting entries at the initial recognition only. They didn't ask you, tell me the entry till next 5 years, 10 years, life of the instrument. They didn't tell you. Now they gave you the present value factor at the 6% and 10%, which is important. So 6% not required, no? Why they gave? To confuse you, to test you. Okay? Yes. What should I do? We'll do it. Calculation. There is no theory here. Solution. Calculation of debt equity. What is the transaction price? 50 lakh. Minus, what is my fair value of debt? Okay, for this you need to see how many contractual cash flows are sitting here. Two types of cash flow. Are you going to pay any principal? Yes, with the premium. 50 lakhs. 50 lakhs, no? Or 5 lakhs? 50. This is 5 lakh number at face value 10 rupees. 5 lakh number at face value 50 lakhs into 50% you are going to redeem, 50% you are going to pay. But what you pay into 1.10 with the premium. So you will pay how much now? 50 lakhs means 25 lakhs into 1.10. You are going to pay 27 lakh 50,000 when? At the end of fourth year, no? 4 year, no. 1st April 2015, 4 years. So you will pay into present value factor they have given you 0.68. Now how much interest you will pay? 50 lakhs into 6% or into 50%? No. You will pay interest on full face value, no. Redemption happens 50% cash, 50% conversion. But for next 3 years, you will pay full interest of 6% on 50 lakhs into annuity factor of 3.17. 20 lakhs, 21,000. And you pass this entry, total equity, so much. And what is your accounting entry? Simple. Will pay. So that's why equity is no big amount you will get. Why? Because something, it's actually fixed for fixed test. Now today you received fixed 50 lakhs. and you're going to repay it only half of it. Balance is a 50. So your accounting entry will be bank account debit to 6% debenture, liability component to 6% debenture, equity component. So this is what you're going to show in SOCE. 50 lakhs bank account debit 50 lakhs to 6% debenture 28 lakhs 21,000, which you show as a liability, and 6% debenture which you show in equity component 21 lakhs 79,000. This 21 lakhs 79,000 you are going to show in statement of other equity first column till the time of conversion. Yes. Next question. Please pause the video, students, and do the next question.